Analyzing your finances. We talked earlier about using financial ratios to analyze your business finances. Here are some ratios that will help you. Sales ratios, break-even analysis. How much do you need to sell in order to break even, where your income equals your expenses, so you begin to make a profit? Without overcomplicating this, your overall break-even point is calculated by dividing your fixed costs by your gross profit margin. For example, if your fixed costs or expenses are $10,000 and your gross margin is 60%, then the sales you need to make to break even are $16,666. Margin. A margin shows you what percentage of each sale is profit. Margin is calculated by dividing the profit, that is, sales minus cost of goods sold, by sales, and then multiply by 100 to give you the result as a percentage. Gross margin simply means that you are comparing total sales and cost of goods sold as distinct from individual products. For a single product, it is the selling price less the cost of the product divided by the selling price. Markup. The percentage you add to the cost price of a product to arrive at your selling price is the markup. Markup is calculated by dividing the profit, that is, sales minus cost of goods sold, by the cost of goods sold, and then multiply by 100 to give you the result as a percentage. For a single product, it is the selling price less the cost of the product divided by the cost of the product. Margin versus markup. People often get these terms confused. The difference is that margin is calculated by dividing profit by sales, whereas markup is calculated by dividing profit by cost. The markup will always be higher than the margin. For example, if the cost of a product is $10 and you sell it for $15, then the profit is $5. The markup is 50% calculated by the profit of $5 divided by the cost of $10. The margin is 33% calculated by the profit of $5 divided by the selling price of $15. Profit analysis, gross profit versus net profit. When you look at your profit and loss income statement, you will see that your gross profit is equal to your sales less the cost of goods sold. Other business operating expenses are then subtracted to calculate your net profit. Gross profit margin. This is the percentage of overall sales that ends in gross profit. Gross profit margin equals gross profit divided by sales multiplied by 100. Net profit margin. This is the percentage of overall sales that result in profit after deducting business operating expenses. Net profit margin equals net profit divided by sales multiplied by 100. Turnover analysis, accounts receivable days. This calculation measures the number of days it takes to collect the cash from sales on credit. The longer it takes to collect the cash, the more cash flow problems you are likely to have, and the more likely that you will have bad debts. The number of accounts receivable days equals accounts receivable divided by sales on credit multiplied by 365 days in a year. Note, financial statements do not usually show sales on credit as distinct from total sales. You will need to look at your bookkeeping records to make this breakdown. Accounts payable days. This calculation measures the number of days it takes to pay your suppliers for goods purchased on credit. Making use of supplier terms allows you to use money in other areas of the business. However, a higher number of days will be an indication of the business struggling to pay its debts and can result in a poor credit rating. The number of accounts payable days equals accounts payable divided by cost of goods sold multiplied by 365. Inventory turnover. This is an efficiency ratio that measures how effective you are at turning over your inventory. It shows how many times a business sold or turned its average inventory. The higher this ratio is, the better, as it indicates how long inventory is being stored. Inventory turnover is calculated by dividing cost of goods sold by average inventory multiplied by 100 to give you the result as a percentage. There are other ratios that your accountant or business advisor may review with you, but these ratios are a good starting point for managing your business. Ratios differ across industries. However, you get a reasonable idea as to how your business is performing by comparing your financial ratios to a benchmark for businesses in your industry. Sites providing comparative ratios for businesses in different countries are listed in the information with this video. In this series of videos, we have reviewed the various foundational pillars of business. In our next video, we will look at how we use this information to survive and actually thrive in our own business venture.